Thank you so much for taking the time to join us for PQMD's March Pillar Talk, ESG's Evolution, How Did We Get Here, and Where Are We Going? A part of a larger series of webinars which the PQMD Community of Practice offers to address major trends, leading thinking, best practices, and provocative issues in global health. ESG certainly falls into all those categories. I'm Elizabeth Ashbourne. I'm PQMD's Executive Director, and I want to welcome you on behalf of our entire team. During our Global Health Policy Forum last year, we had the chance to bring together experts to look closely at the emerging integration of corporate social responsibility, sustainability, and global health through the lens of ESG, and quickly recognized that this was an important topic, one which has inspired PQMD, its members and partners to pursue additional information, perspectives, and learning. So this is what brings us here today. For those of you who are not familiar with PQMD, we are a global alliance of international NGOs and leading healthcare companies committed to advancing the role of product donations worldwide. Founded in 1999, our work is guided by 5 pillars: humanitarian assistance, health system strengthening, disaster response and preparedness, guidelines, and knowledge management. And for more information about PQMD, you can go on pqmd.org or visit our community of practice at cop.pqmd.org. So very quickly, I just wanted to review some housekeeping rules. Go ahead and warm up your fingers, please. Please type your name in the chat box and let us know your organization as well. Because of the large audience, we request all participants remain muted. We do invite you to use the chat box for questions and comments. This session is being recorded and will be posted on the PQMD's Community of Practice this week. And I will share the link, as I mentioned, for PQMD's online community in the chat box. Please be sure to join the timely and informative discussions with our members there as well. So now I have the pleasure of turning it over to Caitlyn Kelly, who is moderating the session and who we have to thank for bringing together this dynamic group of ESG experts. Caitlyn is currently a Senior Finance Manager of Investor Relations at Baxter International. As a member of Baxter's Corporate Responsibility Council, Caitlyn provides expertise and an investor perspective to Baxter's ESG strategy. By also leading Baxter's annual disclosure in alignment with the Sustainability Accounting Standards Board, SASB, for those of you who are familiar, and many of you are, Caitlyn is fully immersed in the ESG world, and we are truly lucky to have her as our moderator today. So thank you very much, and over to you, Caitlyn.
Thank you so much, EJ, for the warm welcome, and hello to everyone on the call. Really appreciate you joining us here today. As EJ mentioned, I work in investor relations at Baxter International, and Baxter has been a proud corporate member of PQMD for I think the last 20 years. I'm honored to be moderating today's Pillar Talk and to be able to help share some insights into the world of ESG. I certainly know from experience that the landscape is evolving very quickly. In the last 4 years that I worked in investor relations, it's been amazing to see the progress in this field and also just the wealth of knowledge that our teams at Baxter have amassed over the time. When PQMD came to me and asked to help design a Pillar Talk, I really dreamt up my ideal group of panelists, and I'm so fortunate to say that they're here with me today. We've gathered some of the brightest minds within the ESG space, and I'm excited for them to be able to share some information with you. I think you'll all walk away learning something from today's Pillar Talk. As mentioned in the Pillar Talk description, our goal for today's discussion is really to shed some light on the recent evolution of ESG. It has been changing very dramatically even over the last 12 to 18 months, even as recent as yesterday, some new news coming out as well. We'll discuss why ESG has taken over the interests of investors globally and how that's translated into action from corporations as well as their partners. Like I mentioned, we'll recap some of the recent moves in the world of ESG, how the standards are starting to unify. And then we'll also try to unpack a little bit what's expected of corporations and their partners, because it's evident that we can't rely on just the efforts within our 4 walls. We really need to collaborate and seek partnerships to really create a positive impact on our world. As discussed, the format of the panel discussion, it'll be a series of questions to our 4 panelists. And then we'll also try and allow some time at the end for Q&A from our audience members. So please enter any questions that you have in the chat feature. And then I'll do my best along with Victoria Hammond to answer or to ask those questions to our panelists and get their answers at the end. So without further ado, I'd like to formally introduce each of our panelists. Their full bios, which were in the invite as well as now linked in the chat, those are available for you. So we'll start off with Christine Bruschi. So Christine is a sustainable investing analyst at Fidelity International, which is the sister investment firm to the US-based Fidelity Management and Research, if you're familiar with that. Christine is based in the UK, and we're very glad to have her back as a panelist with PQMD. She was part of the April forum last year. So thanks, Christine, for being with us. Next, we have Christopher Dean. Chris is a director of investor relations at Q4 Inc. and acts as an advisor and extension of his clients' investor relations teams. Chris, at least informally to me, was introduced as kind of the expert in ESG at Q4. So we're really excited to have you with us today as well, Chris. Next, we have Susanna Draeger. Susanna works as a senior specialist in sustainability reporting at the UN-supported Principles for Responsible Investment. PRI has over 4,000 signatories that have committed to integrating ESG criteria into their investment decision-making. Susanna is leading the PRI's engagement on corporate sustainability reporting, disclosure frameworks, and engagement with standard setters and regulators. And last but not least, we have John Friedman. John is from Grant Thornton, is the managing director of their ESG and sustainability practice. John focuses on developing sustainability strategies and reporting solutions for organizations ranging from middle market up to the Fortune 500. Thank you all sincerely for being with us today and for sharing your expertise with our PQMD members. I'd like to start with a round robin question so that we can hear from each of you and can further introduce yourself if you'd like. So the question is, in our earlier discussions, we've all agreed that ESG is not just a trend. It's something that's here to stay. I think it's still a bold statement to make, and I'd love to hear from each of you, why do you think that that's a fair statement? How have you seen ESG evolve at your own firm? Or maybe how have you started to see signs that ESG is inextricably linked to your business strategy and your processes? So Christine, if I could start with you, please.
Well, thank you, Caitlin. You can hear me all right, yeah? Okay, great. Yeah, thanks for having me again. It's great to be here. Yeah, there is no doubt that investor focus has shifted dramatically toward ESG matters in the last 5 years. I think you'd be living in a hole not to realize that, but I would say even in the last 2 to 3 years, with acceleration even continuing or picking up in the last 2 to 1 year and today, as you mentioned, every day. And the question for me from the investor standpoint is, why has this happened? And if you think about it, investors have always had an interest in the G, that's the governance in ESG of a company, because this is something that we as investors have an active role in. So we own shares in a company, and as such, we have a vote at company meetings. So we have both the opportunity as well as the obligation to pay attention to the G and governance issues within a company, because we'll have the right to vote for or against matters such as election of directors, in some countries, the CEO compensation, shareholder proposals, company strategy matters. So governance has always been important, and that was where ESG started, wanting to ensure that for the sake of our investments and our clients, there was good governance. So, and then you started seeing, depending sort of who you are and where you've been looking, in about the last 5 years or so, there's really been growing consensus and understanding of the critical importance of E, the environment. And obviously the main catalyst or impetus for awareness of the E has really come from climate change and greenhouse gas emissions and how those might affect our companies and our investments. And I would say in the last 5, 3, 2 and less years, the E awareness has been growing to include broader concerns, not just the obvious greenhouse gas emissions and energy use, but other issues like biodiversity, deforestation, water scarcity, hazardous and other types of waste, and other environmental issues that we realize ultimately can impact not just the world we live in, but as investors, the companies we invest in and our immediate returns, and for those of our clients. So S was always sort of the social aspects, they were considered across ESG, but they were sort of the third consideration, I would say, until COVID. So before COVID, people thought about things like employee welfare, and we were looking at issues like slave labor. But without a doubt, COVID really amped up the concerns about social issues. So things like supply chains, other serious matters of employee welfare that we were all aware of, and access to vaccines, something in your industry. And these issues have coincided in time with more awareness of issues of social justice, racial equity, and the importance of diversity across all sorts of areas. So specifically at Fidelity International, we're certainly also evolving in our understanding of and our approach to ESG. So I joined the firm about 2 years ago. We had, I think, 13 people in the team. Now we have 34 across the world, ex-US, and it's really been incredible to see and be part of how much ESG is evolving at our own firm literally every day. One thing I would say, and this might be a small point, but I think it might be interesting to you, is that terminology shifts, and I think it might have been called socially responsible investing 5 or 10 years ago, and recently it's been called ESG. And that term is easy to use and it may well be in use for a while, but it's actually not the term that we use as much anymore at Fidelity. I joined the ESG team and now I'm on the SI, or the Sustainable Investing team, because the term sustainable investing seems to better encapsulate the holistic mission of ESG. So it's not 3 distinct categories like I just talked through, but it's really, sustainability is really a very large umbrella. Which is one of the things I love about it. I always say it's like lifelong learning on steroids. But for an investor, how do we invest in the concept of sustainability, not just governance or environmental and social, but the longer term goals of, as companies we invest in, what will keep them sustainable. So one example, and I think I might be running out of time, is that when I joined, we had just rolled out an ESG rating within Fidelity. It's a proprietary thing that our fundamental analysts would rate companies on 5 or 6 questions related to ESG topics. And in the last 2 years, we've developed a very, very much more complicated, sophisticated version, we call it V2, of our ESG ratings, so that our over 200 analysts will look at companies not just on the traditional financial fundamentals, but also on the sustainability metrics. And it would be far too detailed to go into. It's taken us 2 years of working on it. And now we're just getting every company rated internally for our own purposes, and for the PMs, the portfolio managers, to make investment decisions, not just based on financials, but also on these sustainability factors. So I guess the last thing I really wanted to say about it is that as investors, it is increasingly important that we understand not just the financials, but over time, these sustainability factors, because we do believe in this integration idea that these factors influence our investments and our clients' money. So that's where I'll leave it for now. Thank you.
Thank you so much, Christine. Clearly, I can tell based on the amount of resourcing and work that's been done just at Fidelity that this is something that you expect to be here to stay, certainly not just a trend. So I'll turn it over to Christopher Deans from Q4. Same question to you, how do you see that this is something that's definitely here to stay, not a trend? How has that transpired at Q4?
Great. Thanks, Caitlin. Thank you for inviting me, and thank you to PQMD for hosting this event. To put a context into the position that I come from, I've either been in a corporate seat from a finance perspective, IR perspective, or have been in an advisory position, providing advisory services and support to corporates. My career trajectory over the last almost 20 years has moved from accounting to financial planning and analysis through to investor relations, and I did not get the reminder to turn my phone off. And so from that standpoint, sustainability to one extent or another has been influenced and integrated into what I do for roughly the last 10 years. And it was around long before I've been around. So I don't think that sustainability focus is anything new. Where I've always looked at it has been, for opportunities to generate revenue and or opportunities to minimize expenses, improve margins. And that's through innovation, or sometimes it's frankly driven by costs are going up way too much. How can we innovate to be more sustainable? So that it's very influenced by a business focused value perspective for me. When it sort of morphed from sustainability in general, business sustainability, to that ESG focus, and now as Christine has mentioned, it's pivoting back to sustainability, sustainable investing. In many ways, I look at it as a rose by any other name, was when I entered into investor relations roughly 7 years ago. And that's where I've really started to see that shift. And when I first got into IR, where I worked, we had a very well-established sustainability team, both from an environmental standpoint and from a strictly business profit and loss statement standpoint. But the investors that we would meet with, they would be very focused on SRI type investing, as Christine mentioned. They would generally be either dedicated to what now is referred to as ESG causes, whether it be environmental, social, and or governance, which already has been very well defined, or they were representative of other groups that were dedicated to socially responsible investing. But even in the last 7 years, I saw that began to shift because frankly, when I was in investor relations and I was, for lack of a better term, the new guy on the block, it was my responsibility to sit at the table when our sustainability team was hosting these meetings with socially responsible investors. And that started to change. It started to change with the finance team, the CFO, the CEO, looking more into this in terms of investors and where is sustainably focused investing being integrated. And then, as I'm sure will be repeated many times, as I pivoted away from the corporate standpoint and then into, being more in an advisory role, COVID hit. And COVID fast forwarded everything that already seemed to be picking up steam, both from the environmental standpoint. It became a larger focus, a focus that started on the top with an increased government focus on it. And then the social elements came into that as well. And the speed to which ESG focus started to pick up from the corporate side, from the investor relations side, was frankly mind-boggling. We've seen over the last 2 years what is often described as an alphabet soup of frameworks and standards. They continue to merge and consolidate. We've seen the government focus and regulations increase drastically, and so much so the SEC came down with what has been described as landmark proposed rules, focusing on GHG emissions and disclosures of climate risk, and that was proposed or put forward yesterday. And then even the focus from corporates, when I look at how clients are speaking about ESG or picking up their focus on it, whether they're just starting out or whether they're evolving and turning their ESG and sustainability programs into an outward facing disclosure program, it's incredible. From even just 2 years ago to who was talking about it to who's talking about it now. So to close it all off, is it a trend? Yes, it's a trend that's increasing, that's being regulated at this point. Was there a period where I think some corporates were looking at it as trendy and something that, oh, it's ESG, it's the topic du jour, is it going to go away? There was a moment of that. But I think if that's the standpoint now that a corporate takes, then they do so at their own peril, because ESG, sustainably focused investing, regulations from government, and the consolidation of your standards and frameworks are all moving forward, and it's becoming that much clearer for corporations. So long and short is ESG, whatever the name may be in the future, is here to stay, and corporations are picking up and paying attention to it, integrating it into their wider finance-facing programs as well.
Great, thanks so much, Chris. And Susanna, I know you have a different perspective than the advisory side or the investor relations background. So can you tell us from your perspective how you've seen this evolve?
Thanks so much, Caitlin, and everyone for having me today. It's a real pleasure to meet all of you and get the opportunity to provide the investor perspective. And I want to briefly start off by giving an overview on the trends we are observing at a more institutional level within the principles for responsible investment. I think, Caitlin, you mentioned we have 4,000 signatories now. It's now almost at 5,000 actually. So there's a huge increase. But briefly about the principles for responsible investments, it's a group of pension funds, insurers, investment managers, and service providers, and they have all signed up to the PRI's 6 principles. And coming back to the numbers, this is really an exceptional growth. When the PRI started off in 2005 with just, I think, 20 financial market participants, and the United Nations Secretary General at the time, Kofi Annan, invited this group of the largest institutional investors to join this process of developing the principles for responsible investment. You can see this is already quite a trend. I think we're 17 years in the principles for responsible investment, always continuing to develop more focus. And what we also observe is, I guess, something that Christine already mentioned is that more and more investors are really considering themselves, looking at long-term impact, acting in the best interest of their beneficiaries and clients. And our signatories really work to understand the contribution also to the ESG factors and their investment performance, the role that investment plays in the broader financial market, and the impact really that those investments have not only on risk and return, but also on the environment and the society as a whole. And I would say, as the world's leading proponent of responsible investment, we have been advocating for a globally comparable, consistent, and high quality corporate sustainability disclosure to really help enable investors to incorporate ESG issues and assess the sustainability performance of corporate entities they invest in. And yeah, this is something that came from the very beginning of the PRI, really, was that investors state that ESG issues are a particular concern. They also regularly report to the PRI, and this is something I'm working on. Most of my day really is to secure that they get consistent and comparable ESG data, because it is a substantial barrier to their responsible investment practice. And then I guess that's something Chris already mentioned, is that on top of that, we see so many regulatory action in this space, which I hope I can touch upon later during this discussion. But to conclude in terms of, is ESG a trend? I'd say it is a trend, or maybe it was a trend, but we're also observing that ESG is the new normal in the market and becomes more and more a mainstream topic for investors.
Great, thanks so much, Susanna. And John, would love to hear from you as well.
Yeah, absolutely. And I could not agree more with what the other panelists have said, but I'll just add a bit of a different take on this. I've been doing this work since the year 2000, working inside multinational corporations, helping them leverage their environmental, social, and governance best practices to support their business strategies, including developing innovative products and services to get more of their customers' share of market, but building customer loyalty and employee engagement through things like demonstrating shared values with strategic partnerships and strategic philanthropy, which I think is an important part of the evolution of where ESG is today. And as others have mentioned, the wave was rising, but COVID has really added a big acceleration to it. I've heard this called sustainability, corporate social responsibility, corporate responsibility, stakeholder capitalism, even capitalism 2.0. But where we're getting fast to the point now is where it's just called business, because people are recognizing that this is the way business can and should be done to create the largest amount of value. And a couple of data points, because I recently made the switch over to Grant Thornton, which is an advisory tax and accounting firm, because we saw, and I saw, that this is the next necessary step for the professionalization of ESG. If you look at the value of companies on the Fortune 500 today, and you multiply their number of shares of stock by the amount, what their stock is trading at, you discover that there's a gap between their financial, tangible assets, their financial assets and their physical assets, and the valuation of the company. And in 1975, that difference was 10%. And in 2020, it is 90%. 90% of the value of a company is not based on what it physically owns or its financial reserves. It's based on things like customer loyalty, employee engagement, community relations, and the things that are best maximized through effective ESG management. Another data point, 1 out of $3 invested today in the United States is in this socially responsible, sustainable investing, $17.1 trillion. So is this a trend? You look at the curves on both of those things, the value of intangible assets and the growth of socially responsible investing, and those curves line up almost exactly. Over the last 50 years, this has been a shift. Over the last 20, it has really become something that people have recognized that ESG and putting things like good sound corporate governance into this larger umbrella. But this is why the Securities and Exchange Commission announced proposed regulations yesterday with the goal of providing consistent, comparable data, because there are different reporting frameworks and different reporting mechanisms, and they're trying to allow investors who are putting a lot of faith and dollars or investments in other currencies in companies and funds that are made up of socially responsible companies, the assurance and the professionalization of the data and the metrics to make sure that they're getting what they think they're getting. And I will just point out that having worked in Europe, this is done in Europe, and the result is that these things are managed, measured, reported, and strategized to the same level as companies would put toward the rest of their business acumen. And that is where we're headed. And this cannot be a fad, because the trend is clear. The data supports it. COVID has shined a bright spotlight on it. And I think 10 years from now, we won't worry about what we call it. We'll just, as I said, call it business.
Fantastic. Thank you, John. Christine, I wanted to address this question specifically to you. I know you provided a really nice overview of kind of the evolution and how each pillar has kind of come into the spotlight, but why do you think in general ESG is taking over the interests of investors globally, and kind of maybe some regional shifts of how that's taken effect over the years?
Yeah, I think actually we've sort of touched on the overall trends, and it is quite different being here in Europe to being in the US. I feel like I used to cover tech in San Francisco, and we thought it was the center of the world, and Europe is the center of the world with regard to ESG. I hope we will get more into the evolving regulatory landscape, where Europe is quite ahead of the US, and it's nice to see the US catching up. Asia is, and I also lived in Hong Kong for quite a while, but it's interesting to see that Asia in some regards is ahead and in some regards is behind, but that might surprise you. But I think across the board, we're saying these are trends that are making their way into the mainstream and will be here to last. The trends of investor expectations, customer and employee expectations, building it into business frameworks, investor frameworks, and even the financial frameworks into Susanna's area, the standardizations and measuring principles more quantitatively. It's just all firming up over time. And I've heard people say, if you look at financial regulation, and I don't have a history in that at all, but if you went back, 50 years, 100 years, 150, 200 years, there was nothing like the principles and expectations and frameworks that we have today. And ESG issues are harder to get your head around, particularly on a global level, but there's no doubt that we're moving in that direction. We're just still at relatively early stages. So I hope that answered the question a little bit, or at least gave us more topic for food for thought.
Yeah, no, thank you, Christine. I think one of the themes that's been coming out is just, one, how quickly things have evolved, but two, that there's really this need from everyone's perspective for this standardization. It's a barrier for investors as they're trying to integrate the criteria into their framework. It's certainly a struggle from the corporation side to say, what should we be disclosing? What is even the metric that we should disclose, even if we have an idea of the theme or the topic, that area that we want to disclose again. So, Susanna, I would love to hear from your side, given your area of expertise. Can you walk us through at a high level some of the major changes from last year, as well as even from the SEC yesterday? And why do you think this consolidation is so important? How are you helping further that?
Thanks, Caitlin. Yeah, happy to do so. And I guess I should start off by saying that I really believe, having been working in this space for quite some time now, that 2022 will be the year in which corporate sustainability standard setting enters a new phase. I feel that the recent establishment of the International Sustainability Standards Board under the IFS Foundation really marks a key global development. Alongside, we have seen the EU proposal for a corporate sustainability reporting directive with respective sustainability reporting standards. And then yesterday, I think we're all probably digesting the more than 500 pages proposed rulemaking from the US SEC on climate-related disclosures. And we see that in many other jurisdictions, such as the UK, Canada, Japan, and elsewhere. We see a lot of developments on corporate sustainability reporting. And that's why I believe that's really a core priority for policymakers and standard setters this year. And I think there's a lot of work to be done to make sure we end up in a very aligned way of standard setting, to make sure that we really have comparable data for investors, but also to reduce the burden for companies who should report against those standards. So I guess going forward, we will see a lot more mandatory reporting requirements for corporates on their sustainability related risk and opportunities, but also on their impact and impact on people and planet, to put it widely. I guess depending on the jurisdictions, there will be a different level of ambition coming from the policymakers and standard setters. But as I said, out of these developments, the establishment of the International Sustainability Standards Board, for me, holds the biggest promise for global investors to resolve the so-called, what Chris already referred to, alphabet group of sustainability reporting, which refers to this variety of existing reporting standards. And this is something I guess the IFS Foundation has been done really well, consolidating some of the existing frameworks and standard setters, such as the Value Reporting Foundation or SASB and IRC, the CDSB, and in the future, there might be a potential to add a few more standard setters to that. So building that comprehensive global baseline of high quality sustainability disclosure standards that meet, and I think this is the important part for investors, that meet investors' information needs is very important. And then seeing this being backed up by the International Organization of Securities Commissions, which has 130 member states, and the US is one of them, I think is a great sign for the world to have that sorted out at some point, although standard setting obviously takes a while to agree and put that all together. And yeah, I guess overall, I hope this will all result in better comparability of information for investors at a global level. And I spoke about the effects for companies. I guess having this global baseline will reduce reporting burden, but also help companies to benchmark themselves against each other in terms of ESG and sustainability. I guess that's an important part in this global world we're living in. And yeah, I guess all these developments will be put out for comments. I think for the SEC, you're already in the process of the commenting phase. I can only encourage you really to look at those consultations, and I think this is a great opportunity to get involved. We will certainly do so with our signatories and in close collaboration with other organizations. So yeah, I think I'm going to close here.
Perfect. Thank you, Susanna. That was going to be my question, but you answered it right at the end in terms of, how can people on this webinar really think about getting involved in this process? These are just proposed rules and starting to the foundation of consolidating some of these standards, but we're not there yet. There's still a lot of time to comment, to continue for these to evolve before we get some final rulings and disclosure requirements. So thank you for that. So Chris, I know you touched on this, John touched on this as well. How do you think that COVID-19, the pandemic that impacted the whole world, how has that really impacted the world of ESG, and how has Q4, been helping their clients kind of navigate that?
Well, first of all, I mean, COVID, we just celebrated wrong term. We've just, lapsed the 2-year anniversary. And if I look back to where we were as a company and what we were doing ESG focused and compared today to where we were, it is night and day. And I truly think if I go into the future 1 or 2 years and look back to today, it will be similar, and it continues to evolve and grow with both regulations that are coming down, the consolidations of standards and frameworks, as well as what our clients are doing. In terms of what we're doing and how we're helping the clients, our biggest area is on the website of our business. And clients have been increasingly looking to us to help build out their outward facing ESG disclosures. Disclosures is, I think of the term in the sense of financial disclosure. So for a lot of clients, thinking about it that way is, it's still down the road. They're building towards it. So what we're seeing clients, a lot of them do when they're finally getting going with being ready of presenting something, when they've looked internally and tried to get a sense of what are they already doing, is they're putting up even just simple pages on here's what we're doing, here's what we have already. And then some are taking it the next step and, indicating where they are heading. And it's almost as a stopgap because of the prominence and importance and investor demand that ESG focused investing has now. And then as they evolve their programs, they're also evolving their outward facing disclosures and moving more towards that true world of disclosure and integrating, ESG, websites, frankly, into their corporate websites. And so what they're presenting is evolving as they learn more, as they get a better comfort, as they're comfortable with putting out those metrics and measures to speak to what they are focusing on. And I think regulations are going to help a lot of that as well, the consolidation. And then we're also work with clients. Look, we aren't going to go in and implement an ESG focused program for client. That's not what we do, but we will act as a sounding board, and we can bring to the table, insights that we've gained and knowledge that we've learned from dealing with the large set of clients that we have, where we currently have over 2,500 corporate clients. And so that is a great resource for us to help learn and provide advice and advisory services to our clients in this specific case with regards to ESG. So some of that is clients are increasingly looking to get a sense of from their investor base, who has an ESG focus. And some know already that, look, within the existing investor base, even at the institutional level, there are a lot of ESG focused institutions already making investments. And then even from some of your bigger institutions, when you drill down into them, they have ESG focused funds. So we're doing a lot more work for that for our clients. Sometimes just as a baseline so they can get a sense of where they are. Other times as a way to say, okay, here's where we are, where are our peers? Because benchmarking is important, both from an investor standpoint and in terms of how are you going to disclose. So that's another area. And then once they fully develop their ESG program, they're making their disclosures, it's firmly weaved into their narrative, whether they're perfect or not, because frankly, perfection is, I don't think, a reality, then they can start integrating, okay, here's my story, here's my narrative. Who's that larger investor base that I should be focusing at so that I can help to increase the stability and frankly, just the size of my investor base and that ESG narrative, or I like the way John puts it, the business narrative, because it is just business. Then that weaves into their overall narrative of their IR story, of their financial story, because we are talking about the oh my gosh, my words are escaping me. The asset base, the intangible asset base. And that's really where that ESG narrative works in. So it's evolving at Q4. What we do evolves with our clients. And I'm sure as everything becomes a little clearer, 2 years from now, I'm going to look back at what I'm saying right now. And I'm going to say, oh my gosh, how the times have changed.
That's great. I think we all will be saying that. And John, I did want to ask you a question. I think this is an area that you're passionate about. There's certainly an increasing need for partnership and collaboration to rise to the challenges of this decade. what advice do you have that you can share? We certainly have some NGOs, we have some corporations in terms of the audience members today. What advice can you share with them for how they can partner and further their ESG disclosures and action?
Yeah, that's a great question. And, piggyback on what Chris just said about how times have changed. I actually got my start developing partnerships between corporations I worked for and NGOs in an effort to sort of the early days of ESG, but we're coming right back around to it again. And during that time, I developed what I called 5 keys or 5 elements that a program has to have and to be fully realized. And I'll go through them quickly because the first one is it has to align with both organizations' strategies. That is the business strategy and the strategy of the NGO. Are they in alignment with what they're attempting or trying to do? So that's critical. The second one, it has to be compatible with their day-to-day realities. You can't ask a business to stop doing what it does every day and do something different. You can't ask an NGO to stop being what it is and true to its mission in order for it to work. It has to be compatible daily. Third thing is there has to be a role for employees to play at all levels in the corporate or the organization. And the reason for that is you can't just have it be the green team or the donations team or whatever, what have you. Employees engagement relies on a demonstrated living of the corporation's values, and that they must have a role to play in whatever partnerships you're building. The fourth one, and this is where I think it really has really evolved, is tangible, measurable actions and results. And that's where the reporting comes in. And I used to say local results, but we're living increasingly in a global world. But when I first started, people were talking about the dollar value or the monetary value of the donations, or the volume of products or services, or the number of products that were donated, or the hours donated. And those are all important metrics. But focus on what really matters, which is the impact on people's lives. How many people did you help? How many people benefited from the fact that that partnership existed? Because that gets into the idea that the business, by existing, is contributing in a positive, beneficial way to the communities in which it operates, in which it serves. And the last one is maximize your stakeholder engagement. Make sure, whether it's your investors, your employees, as I mentioned earlier, your suppliers, get everybody on board. You can do those 5 things, you can change the world. And I mean that not just esoterically and not just idealistically, but you could change how a company views itself. I've done this in places where it's literally become the corporate mission has changed to reflect the corporate responsibility initiative. And that's true integration. When you change how the company views itself.
Great. Thank you so much, John. So we have about 15 minutes left. I want to save a little bit of time for audience Q&A if we have some, but did want to do another kind of question to the group. So I'll start with you again, Christine. Question is really, what's your call to action for corporations and NGOs, audience members on this webinar?
Okay, I'm probably going to sound like a broken record after people have already touched on these, but maybe it kind of sums it up. And again, I don't want everything to sound like it has to be about the investor perspective or making money, but bringing the investor perspective and what some other people have said for companies and even for NGOs, I think the call to action is to start with materiality. What of these issues matter most, where you can have the most influence? What issues matter and have the most influence on your company? Are they environmental? What are the key ones? Are they social? And then when those issues, don't just like scattershot, try to do everything and anything, but identify what's most material. And then you need to set policies and practices that you will then be able to provide disclosures and give the outside world, investors, nonprofits, competitors, customers, employees, maybe not competitors, but transparency about your policies and disclosures. And one of the things I think John alluded to also is setting, or maybe it was Chris, setting the targets. So it's nice to have policies and practices, but then we like to see companies and we give feedback to companies, please provide your targets around these metrics that you consider material. And there is definitely not perfection in this area. Start with something as basic as a website, move to, I would say best practice at this point is on your metrics to have near-term targets, medium-term targets, and long-term targets. So you might want to be net zero as a company by 2050. You might want to have HAL, turn in half your emissions by 2030, and you might want to have a reduction by, X, like 25% by 2023. So that's an example, and where we would that would be the call to action, trying to tie all those things together from sort of the nascent stage to a more sophisticated stage. But the bar is going up every year, month, day, as we know.
Yeah, no, I appreciate that, Christine. I think those are some concrete examples, but like you said, the benchmark continues to move day by day. Chris, same question to you.
I would start with make sure whatever you're reporting on, when you're putting that data together, make sure that it's company data centric. I say that in the sense of, don't try to establish your program because you're responding to the buy side and their needs, because you're responding to surveys, because you're responding to raters. Get that data internally first, and then that can help to feed your program and how you respond and build your narrative. And as Christine said, focus on materiality. And with that, I'll add, know what you already have. A lot of companies have a lot of data internally, but they're used within specific departments or business units. There's a lot there already, and there's no need to recreate the wheel. So, broaden your company Rolodex and get on the phone, send emails, use Slack, whatever you use, because I think you'll be able to surface what's already there. Don't ignore risks. Don't just focus on opportunities. Everybody knows that companies, as they start to get into this, are going to reveal risks. You can't ignore them. You need to focus on them. And trying to wrap this up, read wherever you can, stay on top of regulations, the coalescence of frameworks and standards. As Suzanne mentioned, the ISSB, the International Sustainability Standards Board, underneath the IFRS Foundation. The alphabet soup is simplifying. Hopefully it will just be vowels at this point. Do interact with your investors, your stakeholders. You already have relationships. Leverage that. Interact with your colleagues at other companies. A lot of people are starting out fresh with this. A lot are more advanced. You can leverage what's already been uncovered and learned. And look, at the end of the day, it's a cliche, but I think it's true. You're not alone as a corporate, whether it be dealing with investors with sustainability, investment focus, or the larger stakeholder group. It's a learning process, and there's a lot that's going to be uncovered, and be ready for uncovering some stuff that's pleasant and some that is not, because it will get messy at points.
Thanks, Chris. And Susanna, same question to you.
Yeah, probably not a surprise, but I'm coming back to the standard setting developments, and I feel this group of audience has so much experience already on in particular social issues. And I guess there was a saying at a time where you were do good and talk about it. I think getting involved in these standard setting developments and sharing your experience and expertise on all the good things you're already doing is a great opportunity that is open now. And I mentioned previously that investors are looking more towards companies that have positive impact on people and planet, and it's, I guess, now on corporations and NGOs just to showcase what they're already doing and getting involved with these developments.
Thanks. And John, any thoughts on call to actions?
Yeah, the danger with going last when you're on a panel with such informed people is they just take your best talking points and then you're just left going, yeah, I agree. But absolutely, you have to focus on the material issues and leverage the data and information that are already within your organization. The next step is to make sure that data is robust, real, and transparent. And companies like Grant Thornton can help to make sure that what you are measuring is accurate and, if you will, investor grade data. If you're going to be putting it out, obviously some of the data you're going to use to manage things internally, you may not want to talk about it until you have a program to improve it. Then you put it out in context. That said, there's going to be a push for companies to disclose this data maybe before they're comfortable and ready doing it. But as my friend Mark Wiener likes to say, it's okay to begin simply, but simply begin. Programs can and will and should develop over time.
I think that's really important. It's hard when you're, striving for perfection to even get started, but really important to just start getting something out there, even if it begins with what do you have on your website, like Chris was mentioning. Let's start to leverage that, pool that information together. So John, since you've been going last the whole time, there was an audience question, which was, what's your number one tip for how to stay in the know with everything changing so rapidly? Are there any things that people could subscribe to, or how do you think that they can stay in the know on all this?
Yeah, that's a really hard question. Because it also depends on where you're coming from. Are you looking at the regulations? Are you looking at the frameworks? Are you looking at business practices? The real trick is, I think Christopher alluded to this, is manage your networks within your organization and externally, because I can honestly tell you that most of the best ideas I've had have actually been sparked by or come from someone else. This is a large, fast-moving, dynamic space, and it is evolving quickly. It's almost like, how do you know what not to read or what not to pay attention to? But the answer is you can't ignore anything right now, because where's this going next? COVID changed the whole employee-employer contract, what I call the great rethink, where companies are now looking at, should we be working remotely? And they've realized that the efficiency may be the same for some positions. Their costs of maintaining office space has gone down. So there's a cost and environmental benefit to that. There's the social benefit to work-life balance, which helps in the, going back to the rethink, the great, people are rethinking where they want to work, how they want to work, and for whom they want to work. And so, no one could have predicted, although the scientists did predict COVID or an epidemic, they couldn't have predicted how fast it transformed the way businesses are looking at themselves, employees are looking at themselves, cities are looking at themselves and redesigning their infrastructure. So cities took advantage of the fact that there were no cars and built bike lanes, and restaurants are now, the cafe culture of Europe has come to the US as restaurants are moving out onto the street, onto the sidewalk, because of the distancing requirements, and people are saying they don't want to go back to the way it was. So it's really hard to know where the next big transformation is going to come from, other than knowing that these regulatory requirements that are being considered in the US are going to start doing for the US and US based businesses what they did in Europe. And the other thing I'll point out is some of these European requirements are requiring US based companies that have a footprint in Europe to change their game as well.
Great. Thank you so much, John. I know we're getting close on time. I wanted to turn it over to PQMD to do their closing remarks, but sincere thank you to the four of you. This was excellent. I know I learned a ton, and I hope our audience members did as well. EJ, I'll turn it back to you.
Thank you very much, Caitlin. That was, unmute myself. Sorry, can you hear me? Okay, great. Yeah, thank you very much. That was absolutely fascinating. I'm sort of getting stuck in my head, the cafe culture of Europe and not wanting to go back. I understand that. But the other thing that was so impressive to me was the idea that we have been talking a lot about all of the different alphabets that are part of corporate social responsibility and sustainability, and the MDGs and the SDGs and all of that, and emerging into the ESG. So I'm really hopeful that you're right, that ESG will really just become business. I think that would be really wonderful. So I do look forward to continuing this conversation and continuing the dialogue, and certainly providing a platform on our community of practice to continue this discussion, to really see where this goes. And given that it's such a prescient point and such a prescient topic for so many of our companies and NGOs, I suspect that we will come together on this again in probably not too distant future, and maybe even regularly at some point. So I do want to say thank you to everyone for joining us today. We had a really terrific audience, and we had some amazing panelists. And I really want to say thank you for your time and your insights today. Caitlin, thank you for your vision and commitment to bringing this webinar to life, and in doing so, educating and enlightening us on how ESG is here to stay and how we can contribute to its meaningful purpose and development in the future. So please, everyone, be on the lookout for more PQMD webinars and intriguing online discussions through the community of practice. And with that, I'm going to wish you a very restful day, and please stay safe. Thank you very much. Bye.
Thank you so much.
Thank you.